Alternative investments. Okay. Now, when I say the word alternative investments, what usually comes to your mind? Private equity, hedge funds, venture capital. Now, this is not all. Infrastructure, real estate, natural resources, digital assets. There are so many alternative investments. Also, I won't be discussing digital assets. Okay. Apart from that, I'll be discussing everything. Now, talking about hedge funds, private equity, venture capital, all these are what? Pooled investment vehicles. Mutual fund also is a category of pooled investment vehicle, but in mutual fund anyone can invest. But in case of PE, VC, hedge funds, only accredited investors can invest. Accredited investors, matlab those who fulfill the minimum net worth criteria and all. That net worth criteria may be country specific. Okay, the laws differ from country to country. Okay, now the investors are called what is the term? LP, limited partners. The fund manager is called what? GP, general partner. As a general partner, what kind of fees do I charge? Two fees I charge: management fees and incentive fees. Incentive fees is also called performance fees. Now, this is the concept. Now, it may not be necessary that I may charge management fees and incentive fees both. I may charge only incentive fees. I may charge only management fees. Depends on a case to case basis. Now, whatever terms and conditions are decided between the LP and the GP are recorded where? LP agreement. Now, is the LP agreement standardized with every LP, or it may differ from LP to LP? It may differ from LP to LP. Now, to one of the limited partners, I am giving some special terms. So that is called what? Side letters. Now, one of the early investors, to the early investor also I am giving some special terms. It will be called what? Founder share. Okay. Now there is one investor. That investor, LP, limited partner, is so smart that limited partner tells me that if you make any special terms available to anyone, I also want those special terms. That concept is called what? MFN, most favored nation clause. That special terms applicable to anyone will automatically be applicable to that specific person. Means I am having an MFN clause with that LP, most favored nation clause. Okay, fine. Okay. Now, when I talk about incentive fees, there is the concept of soft hurdle rate, hard hurdle rate, high watermark. Let me tell you, high watermark is only applicable in case of hedge funds. Soft hurdle, hard hurdle is applicable in case of PEVC. Okay. Now, what is soft hurdle? Say for example, beginning fund value is 100. I kept a hurdle of 8%, 108, and the ending fund value is 120. Have I crossed the hurdle as a GP? Yes. Will the LPs give me performance fees? Yes. On what? On 108 to 120 or 100 to 120? On this entire value addition of 20. This is called soft hurdle rate. As soon as your hurdle is met on the entire value addition. Had it been a hard hurdle rate, the LPs would have given performance fees only on the excess over the hurdle. Okay. And if there is high watermark concept, okay. High watermark. If high watermark, what is the meaning of high watermark? The previous highest value of the fund. Okay. So that if for example is 110, so then only in excess of 110 the performance fees would be applicable. Now, if you remember, we had done one such question that hurdle rate was calculated over and above the high water mark because the wordings were like that. So please be very careful with the words. Okay. And please practice these numerical questions a lot. Very important. Okay. Here what you had to be careful about is in the question they will be specific whether management fees is calculated on beginning of the year fund value or end of the year fund value. So please be careful. Secondly, they will always mention whether incentive fees is calculated net of management fee or gross. Okay, so if it is net of management fee, you subtract the management fees while calculating the value addition. So it's soft hurdle rate 20 minus the management fee whatever it is, and on that you apply the incentive percent, whatever, if say 20% is the incentive fees. Generally speaking, 2 by 20 is the fee structure. 2% management fees, 20% incentive fees. By the way, that 20% is also incentive fees ka dusra naam is carried interest. Okay. Now talking about European waterfall, American waterfall, which is deal by deal structure. American waterfall, and whole of fund structure is European waterfall. Now when I combine American deal by steel structure with a clawback provision, it is as good as European waterfall. But here again there was a catch. We had done one question also, that hurdle. If the hurdle is not there, then yes, what I said is true. But if the hurdle is there, then it may not necessarily be true. So I hope you are able to recall what I am trying to tell you. Okay, fine. Then there was catch-up clause. The catch-up clause calculation I had shown you. Catch-up clause is same as what? Soft hurdle rate. But only if hurdle is 8% and incentive fees is इतना पार्ट थोड़ा एडिट कर देना 2 मिनट का. Hurdle rate is 8%, LP share is 80%. Okay, so this amounts to how much? How much? 8 divided by 0.8, you do know? 8 divided by 0.8. 10%. Anything over and above 10%, the soft hurdle rate and catch-up clause would give you the same incentive fees. Okay. And no catch-up means it is as good as hard hurdle rate. So if they mention no catch-up in the question, please don't get confused. Anyway, I have shown you the calculation of a no catch-up. So calculation goes like this. 20% is the performance delivered by the GP. Okay. 8% is the hurdle. No catch-up means what? Hard hurdle. Okay. And 2 by 20 is the fee structure. So out of 20%, first 8% will go to whom? Limited partners. Now what is the balance? 12% will be distributed between LP and GP in the ratio of 80:20. This was no catch-up. Okay, fine. Proceed. What? 12% is distributed between GP and LP. See, GP had an incentive fees of 20%. That's why I'm giving 20% of 12%. 20% of 12%, which will be 2.4. And balance will be given to LP. So if you see 100, let's assume some numbers. Hurdle is 8, so 108, and performance delivered is 120. Hard hurdle mein you would have anyway given on this. So 12 into 20% is how much? Is it matching? So no catch-up is the same as hard hurdle. Now I will prove it to you that catch-up is the same as soft hurdle. Catch-up 20%. First 8% up to the hurdle, give it to whom? Now this is considered as if you have given 80% to LP. If 8 tantamounts to 80%, then how much is equivalent to 20%? 2. So next 2% you give it to GP. This is called catch-up. Now what is the remaining? This you distribute between LP and GP in the ratio of 80:20. LP will get 80%, which is 8%, and GP will get balance 20%, which is 2%. How much the GP in all got? 4%. Now if I show you in soft hurdle calculation, 100, hurdle 108 and 120. On the entire value addition, 20 into 20% GP share is how much? Is it matching? 2 and 2. Okay. So beyond 10%, 10%, how did I tell you 10%? Based on this. Beyond 10%, soft hurdle and catch-up will give you the same answer. Hard hurdle and no catch-up will give you the same answer. Got my point? Okay, fine. Now why do I tell you that? Let's consider 9% returns. 9%. So 100, 108. Why 108? Because hurdle 8 and 109 because 9% overall returns. Had it been a soft hurdle pe 9 pe 20% you would have given? which is 1.8. Now if it is a catch up, so 9% may say first 8% goes to whom? LP. Now it will be considered as if 8% is equivalent to 80. So then how much is equivalent to 20? 2%. But is there remaining 2% that I can give? So remaining how much? I will have to give to GP. Did it match? No, because it was below 10%. So 10% is that break even. 10% onwards, 10% and beyond that, soft hurdle and catch up will give you the same answer. This is very important, nowhere mentioned in the book so explicitly. So you need to understand that. Okay, fine. Going ahead, are redemptions and all allowed in case of these alternative investments? Redemptions and all are difficult because the investments which a PE fund manager, the GP makes, the VC fund manager makes are illiquid investments. Mostly PE fund manager makes the investments in private companies or public companies with the intention of taking them private. Now the goal is not to sell the investment so fast, but to add value. Now as a fund manager, as a general partner, my task doesn't end simply by investing. I have to advise the company and add value. Because the more value I add, there are two benefits. LPs will be happy because I'll be able to increase the company valuation due to higher profits and sell the stake at a higher valuation. And my incentive fees also would be higher. So it is in my best interest that I advise the company like that. But a mutual fund manager won't go and advise the company. I had discussed that with you. Okay. The rate of failure is high in case of VC. Okay. Management fees, discussing about management fees, in case of PE and VC, it is calculated as a percent of committed capital. But in hedge funds, it is calculated as a percent of AUM, assets under management. We had discussed the reason also why. Because in case of PE VC, incentive fees is only payable to the GP on realized profits, but in case of hedge funds, incentive fees is also payable on unrealized profits. So in hedge funds, they are getting the incentive fees on an ongoing basis provided there is unrealized gain, so they don't mind getting the management fees on AUM. Okay, the part of capital which has been uninvested is called what? Dry powder. Okay, fine. Now I had discussed 3 stages of this entire cycle. First is capital call, capital commitment, which you can say. Second, capital deployment. Till capital deployment, there will be no returns. And finally, capital distribution. That is when the profits would be realized, because that is when the GP would be selling the stake in companies. Okay. Now, this entire cycle I had told you goes on for about 7-10 years. Okay. You have to give good time for the investment to grow. Hedge funds, on the contrary, they make investments, not even investments, they mostly trade in shares, listed shares and all. They use derivatives, they use leverage, they take short positions and all that stuff. Okay, fine. More on it in the hedge fund chapter. Then the J curve effect, you remember? J curve effect, that in the capital, first 2 stages, capital commitment and capital deployment, the returns would be negative, which is denoted by this part. And thereafter, the returns would be positive in the capital distribution phase. Okay. Then IRR and MOIC, we had discussed that. IRR is internal rate of return, MOIC is multiple on invested capital. Now multiple on invested capital and IRR, I had shown you proper calculations. MOIC ignores the time value of money. It is just a rough measure. IRR does consider the time value of money. So which is a better measure as such? If you see IRR always. In corporate issuers also we have learned IRR is as such, it considers the time value of money. MOIC, because of its simplicity, is more widely used. That as a investment, on your investment, if MOIC is 1.8, means you have got how much? 180 cash inflows on an undiscounted basis. MOIC doesn't consider the discounted cash flows. Yes? Okay. Now in case of hedge funds and all, also redemptions are restricted. So first there is a lockup period. No matter what, you cannot redeem your hedge fund के जो भी units the fund manager must have given you. Thereafter, if you want to redeem your units, it may be done at a cost. as a fund manager, I may discourage you by charging redemption fees, because I will have to liquidate my positions. That may incur a cost, that may incur a loss. So in order to discourage you and compensate my other limited partners for such losses, I will charge you redemption fees. At times I may impose gates. Gates means what? Restrictions on redemptions, but those restrictions will be temporary. So if I feel that the market conditions are very tight right now, if someone comes for redemption, I may not be able to honor that request. So I impose gates for 1 week, 2 weeks, whatever. So in those 1-2 weeks, you cannot withdraw your money like that. Okay, fine. Then less regulated and all that we had discussed. It is regulated, but compared to mutual funds and all, it is less regulated. Fine. Then direct investing, fund investing, co-investing, you remember those concepts? Direct investing is where I directly invest in the company. For that I need to have big capital, knowledge, skills, everything. If I don't have, I have money, but I don't have the time and manage. So for me, what is better? Fund investing. And the third is co-investing. Some money I'm investing directly, some money I'm investing through a fund. I had discussed the reason also why co-investing is done. Okay, fine. Now, in which direct investing, fund investing, co-investing, where will I have the greatest control on my investment? Direct investing, because I'm directly investing into the company. In case of fund investing, what happens? The fund manager takes all the decisions, so it is not under my control like that. Okay, fees also would be there in fund investing. Highest fees in fund investing, co-investing little less, direct investing no fees because you're directly investing. Now if for example you are not an accredited investor, you are not fulfilling that criteria to be a limited partner, so then don't feel disheartened. You have one option, FOF, fund of funds. For that the net worth criteria and all will be less, but still you have to fulfill the net worth criteria, but it will be comparatively less. So your money is going to a fund, that fund is giving money to another PEVC fund, and that PEVC fund ultimately will be investing in the company. So then your money is going through 2 layers. But if your money is going through 2 layers, the benefit is that you are getting the benefit of double due diligence, but then the disadvantage is that double layer of fees also would be applicable, right? Okay, fine. Now talking about level 1, level 2, level 3 investments, you remember that level 1 investments are the ones which are most liquid, price is readily available. Level 2 investments are such which are comparatively illiquid, I will have to use comparables and all to get the price. Level 3 investments are the most illiquid of all. For example, VC funds, venture capital funds, they invest in startups and all, most illiquid. Now a comparable may not be available. So how would the valuation be derived? Using valuation techniques, discounted cash flow method, asset based valuation, PE multiples and all that stuff, right? So level 3 most illiquid, level 1 most liquid. Okay, level 1 I can also say most transparent, level 3 most opaque. Clear? Okay, fine. Now here again there was a problem that I'm a venture capital fund. I also prepare my balance sheet, and in my balance sheet on the asset side I show investment in startups. Now level 3 investments, year over year I more or less show the same valuation. Now even though there may be a fall in the valuation, I may not necessarily show it at a reduced valuation. So this is a problem. This is called mark to model accounting. Mark to model accounting, which creates a problem. So I had discussed the consequences. Your standard deviation, your riskiness would appear to be lower because year on year you are more or less showing the same value or slightly higher value, and your returns would appear to be higher like that. Your actual returns would be known only when you sell the investment. In the capital distribution phase, would your actual returns be known? All this is done on an unrealized basis. I hope you understand that. Okay, fine. Clawback provision, it favors whom? Limited partner or general partner? Limited partners, definitely. Okay. Now, leveraged returns. Leveraged returns, there is a formula given in the book, but I am not at all comfortable with the formula, and so you shouldn't also be comfortable with the formula because you may forget the formula. I have given you one simple technique to calculate leveraged returns. I had taught that technique in quants. Okay, so you can ignore the formula completely. Those whose quants is not done, please wait, it will be taught in quants how to calculate leverage return, and it's a very good technique, shortcut, you will easily understand that. Okay, fine. So you can cancel the formula whatever is given. Fine. So I have discussed the first two parts. where all the fees discussion, the general terms and all are discussed. Now let us discuss the specifics. Investment in private capital, equity and debt, that chapter. So here mostly discussing about the private equity strategies. One of the major strategies followed by PV is LBO, leverage buyout, where I take on debt and with the help of that debt and some money is your money, limited partners money, I invest in that company. Now taking on debt enhances my return. I had shown you the entire calculation in corporate issuers, how taking on debt enhances your return on equity, but then it is a double-edged sword. It enhances your returns, but at the same time, if there are losses, it enhances your losses also. So please be cautious about it. Okay, then there is management buyout, management buy-in. Management buy-in means what? My management replaces the existing management. Management buyout means existing management also is involved in buying the stake. Like that, I had given you the example of Safari Industries, if you remember. Okay, fine. Then talking about venture capital investment stages, the first stage is called what? Formative stage. Now usme bhi there were 3 sub stages. The first one in the formative stage was pre-seed capital. Pre-seed capital. Also angel investors invest, mostly individuals. Yes, theoretically, see, we discussed that angel investing may mostly individuals and all are there, but I have seen such cases where funds also do participate in the angel investment phase. So practically I am telling you what is applicable. Theoretically you can understand it like this. Okay, fine. Second, after that is the seed stage, where the venture capital funds participate, and that you have to know that in the angel investing phase, the funds obtained by the company are mostly used for like market research, survey and all that, testing the product feasibility, etc. In second stage, you would use the money for commercial operations and stuff like that. You want to do some further research, etc. Now this is again generalized, may not be exact if wo stage ka paisa will be utilized for that specific purpose only. And then after that was early stage financing, where the funds would be actually utilized for starting your commercial operations, production and all, if you are engaged in a goods business. That was the first formative stage, and we discussed the 3 sub stages. Okay, you have to remember this in the particular order. Formative mein first pre-seed stage, angel investing, then seed stage, and then early stage. Now I am coming to second part. After formative stage is the expansion stage or late stage venture capital also you can call it. Here the funds would be utilized, the funds obtained would be utilized for maybe new geography, venturing into a new geography, maybe into a new product, etc. Fine. And the third stage is called the mezzanine stage. Now between the time the startup decides to get an IPO till the time it actually gets an IPO, whatever is the fund requirement in that specific stage is called as mezzanine stage financing, also called as what? Bridge financing. Okay, fine. Now don't confuse mezzanine stage financing with mezzanine debt. You remember mezzanine debt we had done? I'll be discussing now mezzanine debt. So those two are different concepts. Okay. Now talking about the exit strategies. Private equity venture capital exit strategies. Most popular is what? The IPO strategy. The advantage was greater marketability of the company. And so many companies we come to know because they are coming up with an IPO. Otherwise we did not know those companies existed like that. Then SPAC, special purpose acquisition company. Now what was one specific point of SPAC? That in case if a company is being acquired by a SPAC, and if it is a private company, it compulsorily will have to turn into a public company. That you need to know. Okay, SPAC, IPO. Then second one was trade sale. Trade sale mein what is happening? I am a PE fund manager, GP. I am selling the stake in Sun Pharma, my stake in Sun Pharma to Sun Pharma's competitors. That is called trade sale. But as a PE fund, I sell the stake in Sun Pharma to my competitor. Maybe I'm Blackstone, I sell my stake to Carlyle. Then that will be called secondary sale. Okay, so this is third. Fourth is recapitalization, taking on debt and buying back. I had given you the example of Oyo, Byju's, how they are doing recapitalization. Byju's to theek hai now, Oyo, how it was doing recapitalization like that. Then I had given you the example of write-off. Write-off I had taken FTX example. Okay, I had shared that letter with you, how the limited partners were consoling the general partners. General partner was consoling the limited partners. You had read that letter or no? I had shared it with you. Okay, fine. So these are the 5 exit strategies. Write off may, it's not a strategy as such. I mean, you have lost hope. You are writing off that investment from your books of accounts and considering it as a loss. Okay, fine. Go mechanic example, I had discussed that, again was an example of write off. Fine. Now talking about private debt. Private equity we discussed. Private equity is investment in the form of equity. Private debt, naturally investment in the form of debt. Now in a private debt there is venture debt, giving debt funding to a startup, but that startup should have some positive EBITDA and all, so that it will be able to fulfill your interest obligations. Then there was mezzanine debt. Mezzanine debt is what? Ranking lower in the seniority. So more risk, but then more returns also. Then in mezzanine debt, such features may be attached, conversion features. So in case if the company is unable to repay, my debt will be converted into equity shares of the company. The company may give me warrants also. Warrants gives me the right to buy company shares at a predetermined price. Then it is up to me if I want to exercise warrants or no. Then there are leveraged loans. I am a private credit fund, private credit fund we call it. And you have given me your money. You are whom? You are limited partners. I give your money and I borrow money and I give it to the company in the form of debt. That is called leveraged loan. I myself am borrowing from somewhere and lending it to a particular company. Leveraged loan. Okay. Then there is direct lending. Direct lending mostly happens from bank's end. Okay. Fine. Then unitranche debt. Unitranche debt is what? Is combining the features of multiple tranches. I had explained the tranching structure to you. Senior secured has the first priority. Then secured, junior secured, subordinated, unsecured. Such tranches are there. Unitranche combines the features of multiple tranches. So it is a blended kind of a tranche where returns would be average returns combining. See, the lowermost tranche gets the most returns, uppermost senior secured gets the lowest returns. So unitranche returns would be somewhere in between, and on the priority front also it would be somewhere in between on an average, like that. I hope you remember all these points. Okay. Venture debt, may we had discussed the example of Altiria Capital and all that. Some specifics I had told you about the market. Okay, fine. FD leverage debt. How come? You are making an investment in FD. How is it debt for you? From an investor's perspective, though, it becomes an investment. Ajay, you are asking from bank's point of view. So it is borrowed money from someone and then bank is giving loan to someone. See, the word leverage loan generally is used for private capital funds, private credit funds. Okay, fine. Proceed. But yes, traditionally the business has been such of banks. Okay, you can sort of think about it that way. Okay, fine. A distressed debt. Yes, distressed debt is what? I am investing in debt of such companies which are on the verge of bankruptcy. Now, why am I betting on such a company? Because I have the ability to turn around. I'm an expert in that. So once the company turns around, I may be able to sell my debt at a higher valuation, like that. So distressed investing not only can be done in debt, it can be done in equity also. Remember that. Okay, fine. So I will invest in equity of a distressed company. I will get the equity at a very cheap valuation. Then I will turn around the company, get it to the levels of profitability and all. Then valuation of the company will increase. Then I will sell it at a higher price. I had given you the example of JC Flowers here, where it was contemplating a stake in Yes Bank and all. Multiple examples we had discussed. Okay. Then when it comes to debt, of course, interest rate can be either fixed or floating. I had explained you the concept of benchmark plus spread. Now, spread usually remains constant. What keeps on fluctuating? It is the benchmark. Now, in case if your fixed income is not done, please have some patience. It will be explained properly in depth in fixed income. What is this concept? How it is actually used? There was a benchmark called as LIBOR. LIBOR is no longer in use. Now we follow a benchmark called SOFR. I'll explain everything why LIBOR had been phased out, why SOFR has come into existence. Just wait for fixed income. And those whose fixed income is done, you already would be knowing all this. Okay, fine. Now vintage year as a concept, what does vintage year mean? Vintage year means that year in which the fund had made its very first investment. Okay, we had discussed that when there was an economic downfall, and if the vintage year was the same year for a distressed debt fund, the returns would be high, because in an economic downfall the valuation naturally would have been very low, like that. Okay, fine. Now coming to the chapter real estate and infrastructure. First, let me cover real estate. You can participate in real estate in four ways we had discussed. Broadly speaking, two ways, debt and equity. Two, within debt, two ways, direct, indirect. Within equity, also two ways, direct, indirect. Let me discuss direct debt. Bank giving a loan to a home loan borrower. Direct participation, but by way of debt. The bank won't enjoy any price appreciation in the house. It will periodically get the interest. Indirect debt, you can buy MBS, mortgage backed securities. Again, those whose fixed income is done would be in a position to understand it better. Concept of securitization. If not, it will be clear absolutely in fixed income, MBS. Okay. Now, when it comes to equity, if you want to participate by way of direct equity, you buy a house directly. If you want to participate indirectly through equity, you can buy shares of REITs, real estate investment companies, real estate investment trusts, or you can buy shares of builders list, construction companies like Macrotech developers and all. That is ROEC, real estate operating companies. That is how you can have indirect participation. Now guys, as an individual, if I buy a property, there are advantages as well as disadvantages. Advantages, I will have control over the property, I'll be able to enjoy the price appreciation if any, etc. But disadvantages that I need to have time and knowledge to manage that property. There are a lot of legal regulations and all that I have to consider. Depreciation benefit as an individual, do I get? No, I don't get depreciation benefit. But if I have taken a loan to buy the property, do I get tax benefits when I pay interest and all that I had discussed? 2 lakh, up to 2 lakh in India, you get tax benefit on interest, and principal up to 1,50,000 under 80C. All that we had discussed. Okay, but when it comes to a company, if a company buys real estate, company can enjoy the depreciation benefit. Okay. Now, what was the speciality of REITs, real estate investment trusts? Those shares, say I'm a REIT fund manager and I give you shares. I collect money from you. I have invested in properties. I get periodic rentals which I pass it on to you. Now, in case if you are not interested to stay invested in those shares, can you sell the shares to someone? Yes, REIT shares are tradable on the secondary market and those shares are liquid. So that is one benefit. And what was the benefit again? As per laws, I had told you that the fund manager has to distribute 90% of the income, so that periodically you get some income like that. And plus, whatever the capital appreciation will reflect in your share price, capital appreciation of the property. And in REIT, it can be either commercial property or residential property. We had discussed multiple, like Blackstone buying stake in Market City, Kurla, Phoenix Market City, and all that stuff. Okay, Prestige. In multiple cases. Okay, then when it comes to real estate, you remember that part, core plus, value add, opportunistic. As you go up above the spectrum, what about the riskiness? Increases, but then returns also increase. Core, you are investing in, say, a ready property. Core plus, you are making some minor refurbishments here and there. Value add mein, you are making some major adjustments to the property. And opportunistic mein, though, you are changing the face of the property. Remember? Okay. Now, when I talk about leverage, see, I am a fund manager. I manage investment, real estate properties and all by using investors' money. In core, if I'm following core strategy, I will be majorly investing your money. You are limited partners. I'll be taking on debt, but I may take on little debt. As I progress from core to core plus, the debt levels will increase. Core plus to value add, the debt levels will increase even more. Opportunistic, the leverage may be very high. So opportunistic is the most risky, but returns also would be the highest provided things go well, like that. Okay, fine. So this was about real estate. Fine. Anything that I'm missing out in real estate? I think I've discussed everything majorly pertaining to real estate. No, that is in infrastructure, brownfield, greenfield and all. So that's why I did not discuss that in real estate. Is transparency there in REITs? Will you come to know where the REIT fund manager is investing? Yes, of course, there has to be transparency there. Okay, fine. Can we discuss infrastructure then? Okay, now when it comes to infrastructure, there are various types of infrastructures: public utilities, social. Then infrastructure can also be classified on the basis of the stage of their development. Greenfield, completely not developed at all. I mean, you are starting the project from scratch. Brownfield, the project is already ready. You are making some refurbishments and all. You are making some changes. And then there was secondary stage where you are directly investing in that real infrastructure ready, and you are getting the cash flows. We had discussed the case of airports. Airport also is a major infrastructure investment. Ports, normal your shipping ports and all that. Highways, roadways, all that. You remember airports mein you had told me dukan. So that part, how the airport makes money, all that we had discussed. Now, do you have the capacity to buy an airport directly, buy a stake in airport? No. So then there was InvIT, Infrastructure Investment Trust, that we had discussed. That is like REIT only, but InvIT will make investment in infrastructure. Then I had told you how, extra, we had discussed a lot of extra stuff here. Highways, what method are the projects awarded? HAM, hybrid annuity, build, operate, transfer, BOT, EPC, engineering, procurement, construction. All that is not given in your book, but just for understanding purposes. Then I had discussed the take or pay arrangements. Take or pay, PPA example I had given you, power purchase agreement, SECI, Solar Energy Corporation of India. Remember that? So that gives the most amount of confidence. Take or pay arrangements. Then there is usage based payments, how much ever you make it available. Then third category was what? Availability based payments, like that. Okay, fine. And then yes, of course, they have given you PPP, what is public private partnership. That entire process I had explained you while explaining you the highway and all. So for a few years, first engineering, procurement, construction and all will be done by the private players. Private players will operate it for a few years under BOT, build, operate, transfer. Then the ownership may transfer to public, like the government, or maybe to some other private player, as the case may be. So most of the infrastructure projects are undertaken in the PPP mode, public private partnership, because of the huge capital investment involved, like that. I think infrastructure was only that much, very limited. Okay, one important thing that I want to highlight in the real estate part is the loan to value ratio. It should be less than 1. Loan to value ratio should be less than 1. So whatever is the value of the property, a lender would never lend more than the value of the property. In fixed income, I had discussed subprime mortgage crisis, where in that absurd, it was LTV was above 1. It was highly absurd that time. Okay, so wait for fixed income, those who are not yet done with fixed income, to know more about that. Okay, anything else that I'm missing out on? Real estate infrastructure, small chapter, majorly covered everything in that. Okay, InvITs, what? Tradable. InvITs are also tradable. Okay, fine. Okay, proceed. Now what remains? Hedge funds and natural resources. Let's first finish off natural resources. Natural resources may majorly I'll be discussing about what? Timberland and farmland. Okay, now timberland, farmland, 3 sources of income they can produce just by the appreciation of the property. You are making products and selling that. And what was the third source of income? Leasing it. Right? Okay. Now, as individuals, can you invest in farmland? Yes. 1 acre, half acre, whatever. But as individuals, can you invest in timberland? No. I had given you one example of my relative of timberland. So it is mostly, it should be left to institutional investors. I had shown you TIMO, Timberland Investment Management Organization, where they are managing literally, you saw how crazy the figure was. Acres and acres of land they are managing, timberland. Now what is the advantage of farmland and timberland? Both are beneficial for environmental purposes. Basically, you are constructing trees, planting trees, which will help absorb carbon dioxide and all that. And moreover, both of timberland and farmland, the products which we obtain from farmland and timberland, both are necessary for human survival, right? Okay, fine. Farmland will give you what? Food to eat. Timberland will give you a house to live, wood and all that, logs of wood stuff, etc. Veneer and all, I had explained that. Sunmica, which you call, that is all obtained from farmland, timberland, sorry. Okay, now the advantage of timberland is that you can harvest whenever you see market demand. It's not like a perishable item or something of that sort. You can harvest it like that. But farmland, then it is a perishable item. That is one disadvantage of farmland. You will have to harvest at particular point of time, otherwise the crop will die. Okay, fine. Then in farmland, if I talk about farmland commodities, basically commodities are of three types: energy, metals, and your agricultural products. People do trade in commodities, but do they trade in physical commodities or commodity derivatives? Commodity derivatives. And what is the advantage of commodity derivatives? That you can avoid storage cost. Okay, you do not have the hassle of storing it physically. Okay, now here I would like to introduce some derivative concept, forward or future price, because most of the commodity trading takes place in derivative markets. Is spot plus storage cost minus convenience yield, the whole thing compounded at the risk free rate. So risk free rate. Again, this entire concept I will be explaining you in depth in derivatives. Right now I am just giving you a glimpse of it. Okay, now whenever guys futures or forward price is above the spot price, the situation is called what? That situation we term it as contango. Whenever futures or forward price is less as compared to the spot price, that situation is called as backwardation. Now backwardation is beneficial for long only investors, long investors, and contango is beneficial for short investors. How, what, when, why, that method entire I'm not discussing right now, otherwise it would take on too much of time. But I have explained it to you how there was one assumption inherent. The assumption was what? That spot price remains constant throughout. Only then this theory will hold true, that contango is beneficial for short parties and backwardation is beneficial for long parties. And when is the situation of contango possible? When storage cost exceeds the convenience yield. And when backwardation is possible? When convenience yield exceeds the storage cost, right? Okay, fine. Now talking about natural resources, most of the trading takes place in derivatives. Yeah, CTA, commodity trading advisors. Those are what, like, you can consider them like mutual fund managers. Those are fund managers, but mostly trading in what? Commodities. That is why they are called CTAs. Now, there can be some CTAs where there will be restrictions, like you have to be an accredited investor, only then you can be an investor in that CTA and all. And some CTAs may be open to everyone like a mutual fund. So that depends on a case to case basis. But the point is that CTAs means the special asset manager is managing your money and investing in commodities. Maybe he must be investing in physical commodities, trading in commodity derivatives, whatever. Managed futures, futures only, like that. Okay, fine. In India, do we have commodity derivatives? Yes. But then commodity derivatives in India, we as such have mostly on metals and all. MCX, like that. Perishables pay, we don't have that much. I mean, on tomatoes and all, if you see, there are no futures and all. But I kid you not, in US there are futures on oranges, tomatoes, everything. There are futures on water also in US. Yes, not a joke. It is. But Indian markets are not so developed, so we don't have commodities, derivatives and all. Maybe, but then it should be there because it would help the farmers. But anyway, okay. Perhaps, or maybe it is inertia on the part of the market developers. Anything could be the reason. Fine. So anything in natural resources which is left? that part, no, as such I'm not convinced with the correlation part and all as such, because they are commenting on the correlation based on the time period which they have selected for study. So I cannot generalize it, but for you, if you want to remember it, please do it. If you are unlucky enough, they might ask you a question on that, but in my opinion you shouldn't be remembering all that, because it is highly, correlation is highly dependent on the time period selected. Okay, fine. All they have said is commodities have very low correlation with your other traditional asset classes like stocks and bonds. Yeah, one thing I forgot to discuss, which I would like to highlight, that real estate and commodities both are a good hedge against inflation. This is a very important point, because your rentals increase periodically. You have that escalation clause in your rentals, and your commodity prices, inflation increases. Why? Because commodity prices are increasing, and inflation is measured on a basket of goods, and in most of the countries, basket of goods mein food is included. So if food prices increase, your inflation is increasing. So it acts as a hedge against inflation, commodity, like that. Okay, now one thing that I would like to point out in commodities is that some commodities have very long lead times. Matlab, it takes a lot of time to produce those commodities. So if there is sudden demand for those commodities, say for example apples, can I produce apples on the go? No, it will take time, right? So the price of apples will increase at that point, because supply is not there and demand is there, like that. But when it comes to crude oil, I may be able to extract it fast, because I don't have to manufacture, I have to extract and I sell it, like that. So some commodities may have a short lead time, some may have a very long lead time, like that. Okay, mostly the ones which are, remember the difference between hard and soft commodities. Hard commodities are those which are extracted from the earth's core: crude oil, iron ore, gold, copper. Lead times for that will be less, but lead times for soft commodities which have to be grown, produced, lead times for that will be high. Okay, fine. Any other doubt that you have in natural resources? Okay, please let me know. Okay, now hedge funds, wherein we'll be only discussing about the hedge fund strategies. Now I'm not discussing the high watermark and all, which was already discussed earlier. Okay, now let me focus solely on the strategy part. Nothing, no discussion about the redemption fees and all, everything, only strategies. When it comes to strategies, I had told you there are 4 broad categories within which there are subcategories. Now when it comes to equity strategies, what was the mnemonic I had told you? SFM. Remember, we had a subject in CA final, SFM, strategic financial management. So S was short bias, F, 2 F's, fundamental value, fundamental growth, and 1 M was for market neutral, and other M was for, there were 2 M's. F के 3 है क्या? Okay, इतना पार्ट कट कर देना इधर तक का. Okay, now when equity hedge fund strategies, so equity hedge fund strategies में we had S short bias, F square fundamental value, fundamental growth, and M market neutral. Okay, one more I had told you which is not there in your book, but which was dedicated short. Okay, fine. Remember, SFM was the mnemonic, S, F पे square and M. Okay, now long short, one is long short. Okay, that you can consider it separately, the fundamental long short. Now long short mein what? Some quantity you can go long, some quantity you would go short, but net you are long. It is a long bias, and short bias is opposite. More portion is shorted as compared to going long. Okay, fundamental value you hunt for value stocks, fundamental growth you hunt for growth stocks. Now I had explained you the difference between value and growth stocks. Which stocks have more potential to enjoy rapid price appreciation? Growth stocks. Which stocks give more dividends? Value stocks. So that all concepts we had discussed. Okay, so that is what is the fundamental value, fundamental growth strategy. Dedicated short, Hindenburg example I had given, only short selling, nothing else, no going long or nothing. Okay, so these were equity strategies. Now when I come discuss with you event driven strategies, what mnemonic I had given you to remember? MADS, M, Merger arbitrage, you are buying shares of that company which is the acquiree company, and you are short selling shares of the acquirer company. I discussed the reason why, because acquirer company may issue additional shares, take dilution, price fall, and it is always assumed that in an acquisition the acquirer is overpaying for the target. That was one inherent assumption. That is another reason why you short the shares of target company. But that I had discussed the reality. What happens is not always the case as you may be contemplating may happen. HDFC Bank, SDFC ka example I had discussed. The share price of both the companies was increasing. Yeah, so you may face losses also. It is not so straightforward as it seems. And moreover, if the merger announcement goes off, it's called off, then both sides pay you face losses. Z Sony example we had taken, merger announcement was called off. Yes, okay, fine. Then A activist strategies. You buy a good enough stake in the company in order to drive the strategies and all of the company. I had given you an example of Nelson Peltz, Disney, how he was an activist shareholder, how he demanded a board seat and all. Ultimately his request was rejected, but the point is that they can pressurize, they can, tell other shareholders that what are you sleeping, our company has a lot of potential, let's fight towards the betterment of our company and all that. So they will be actively involved in the efforts of the company to revive the company. If the company has a lot of cash, why is the company not undertaking any project? If the company doesn't have any project opportunities, reward the shareholders in the form of dividends. Why is the company keeping so much of cash? Like that, the activist shareholders can pressurize the companies. MADD, distressed investing, which we had already earlier discussed, and S is special situations in case of any spin-off, demerger and all. I had discussed with you the example of ITC and ITC Hotels. ITC Hotels is now getting demerged from ITC, so better value addition and all, value creation and all. So a hedge fund would sense such opportunities and accordingly take positions in such shares. Okay, fine. MADS. Now when it comes to opportunistic strategies, there were two: managed futures and one is macro strategies. Macro strategies were super interesting. You see the macroeconomic picture of the country and accordingly take trades. I had discussed the example of carry trades. It's a macro strategy. I had discussed the this is my favorite example of our Turkish central bank, how hedge funds were making money based on the foolishness of Turkish president. That entire case study we had discussed, Turkish central bank governor getting fired and all that stuff. Okay, now when it comes to relative value strategies, I had given you one mnemonic to remember. As CA students, we were required to do one course. That course was called GMCS. This was the shortcut I had told you to remember. G, general fixed income. Whatever was the undervaluation, overvaluation in fixed income securities, you accordingly take positions long short in that. M, multi-strategy. You combine multiple strategies and accordingly wherever you see the opportunities, you act on that opportunity, multi-strategy. C, convertible fixed income. You buy convertible bonds and if you sense some arbitrage opportunities, you accordingly exploit that. Now this convertible arbitrage fixed income, now you would better understand once you are done with fixed income and moreover convertible bond concept. In that I had taught you the convertible bond price. If you remember, convertible bond price is max of straight value or conversion value. Fine. Basis that I had discussed how arbitrage is possible. And last S stands for what? Specific fixed income. Okay. Fine. Okay. You remember it like this, no? Okay. GMCS. GMCS was General Management and Communication Skills. So that course we had to do. So accordingly you can remember on those lines. Relative value strategies. Fine. G, general fixed income. M, multi-strategy. C, convertible arbitrage fixed income. And S, specific fixed. Why am I telling you to remember that? Usually I don't tell you to remember stuff, and when I tell you to remember I give you some mnemonics is because you can be asked an MCQ like that, which of the following is not an event driven strategy. So you need to know now which are the event driven strategies. That's why I told you that MADS is for event driven strategies, like that. Okay, now when it comes to hedge fund, indexes of hedge funds are not available as such. As an index provider, I have to beg a lot to the hedge fund managers that provide me data and all that. Now that index is subject to biases. See, if I want to construct an equity index, it is comparatively easy because data is available in public domain. But for such opaque investments and all, it will be problematic. Now we had discussed biases, survivorship bias. As a hedge fund manager, would you give details of poor performing investments? No. Would you give details of those investments, those funds which you were operating earlier but now have closed down? No. Then you will only give me performance details of good investments that you have made which are currently profit making. So that is what is survivorship bias. Okay, fine. Then backfill bias and one more, selection bias. Selection bias, I am not selecting the hedge funds in accordance with the rules set out in the index. That was selection bias. Backfill bias, I am including some backdated hedge funds. Now my point was that 2011 onwards, when I am making the index, only those hedge funds which have made their first investment from 2011 onwards should be included in the index. But now I am including a particular hedge fund whose vintage year was 2010. Backfill bias, I had to include only those hedge funds which were from 2011 and onwards, right? So this will again tantamount to backfill bias. And usually why would I do that? Because I may want to overstate the performance of a particular index. Now it is very difficult to compare a hedge fund manager's performance with the index because the index itself, उसका ही ठिकाना नहीं है कुछ index का. So hedge fund performance, if you want to see of a particular manager, see it on a relative basis. So for example, hedge fund A, how much returns has it delivered in comparison to hedge fund B? Hedge fund B, how much returns has it delivered in comparison to hedge fund A and B? So here on a relative value basis, in relation to your peers, the comparison would be more appropriate and not with respect to a specific benchmark, because there is no appropriate benchmark for a hedge fund. If I am an equity investor, you can easily and that too if I invest only in large cap stocks, you can easily compare my performance against Nifty 50, which is a large cap index, which is readily available. But the point, that is what I am trying to make, that hedge fund indexes, even if they are available, they suffer from such biases, survivorship, backfill and selection, which is what makes comparison with an index so difficult and not so worthy of comparison. Okay, you understand this? So this was all about your hedge funds. Anything else? SMA, one specific point that I want to discuss. SMA is what? Separately managed account. As a fund manager, I'll be managing funds only of one client. That client has to be an ultra HNI. Only then I can afford. The fees can be negotiated. The client will say that I am giving you a lot of money to manage, so give me a negotiated fees. But then here, one thing that you have to remember with respect to tax, whatever buying and selling as a fund manager I will do, the tax incidence always will fall on the client. So if I sell anything on behalf of the client will have to pay the tax. But when it comes to mutual funds, if I am a mutual fund manager, if I sell shares, I won't have to pay tax. As a unit holders of the mutual fund, you will have to pay tax only when you sell the units. So tax incidence gets delayed when you sell the units. But in case of SMA, whatever transaction happens, the ultimate incidence falls on the client always. So that's an issue. Okay, and moreover, in an SMA, what happens is there is no skin in the game of the fund manager. Whatever funds are invested are of the clients. But in case of GP, private equity, hedge funds and all, there is skin in the game. The GP also invests his own money and some money is of the LPs, like that. Okay, getting the point? Fine. Any doubt that you have? Master feeder structure is like a fund of fund structure. There is one master fund, then there are feeder funds. Feeder funds feed into the master fund. So for example, if you are not directly able to invest in a master fund, what you do is you invest in a feeder fund. That money which the feeder fund collects, the feeder fund ultimately gives it to whom? It gives it to the master fund. Now this can be done for some tax advantages and all that stuff. So there is as far as I remember, in India there are feeder funds which will collect money from you. Axis has feeder fund and all that. HDFC has feeder fund. Then this money usually goes to a master fund which is situated abroad. So like that you can get the benefit of international investing. Abroad, you may not be directly able to invest, maybe due to some regulatory constraints or whatever. So, like that, the structure, master feeder structure is there. Okay, fine. Okay. Can convert it to equity. Yes. If you have given debt to some company and if the company is unable to repay the debt, the company can convert it to equity midway. Even if it is not convertible debt. Yes. So what I will feel, see, I am a bank. You are a company. You are not able to repay the debt. Usually the bank may not convert it to equity. In some cases it can. Bank will do a one-time settlement. Okay, you owe me 9,000 crores, give me 3,000 crores and finish it off here. Something is better than nothing, like that. Or some cases where the bank feels that, there is a good chance of survival and recovery, the bank may convert its loan into equity of the company, like that. Then there's a lot of process that goes on. IBC, insolvency, bankruptcy code and all, committee of creditors is formed and a lot of hassle goes on. So it's a complicated process. But point is, it's possible. Okay. Clear? Okay. Any other doubts that you have overall in alternative investments? Again, highly theoretical, only practical part was pertaining to your fees calculation, otherwise hardcore theory. So hardcore theory mein super duper reading very important. I have seen questions which are asked so minutely that you have to be absolutely thorough with whatever you read and do the markings and all. Make use of our notes which we have given. Those are summary notes. Okay, fine. Sure, no doubts. I can stop.